You're with us here on a fresh new edition of Taking Stock, the show where we look back at the week which has gone by, and what a week again, once again, it has been. The rally continues. But we also, more importantly, look ahead at the week which is coming up and present things which might be carried over from the week which we finished. And of course, new stuff which you need to pay attention to. I am Prashant Nair. With me, as always, my colleague Surabhi. Hi, Surabhi.
Good evening, Prashant. Well, what a week. The Bulls are going to be partying hard this weekend. I can perhaps say that. So, yes, the numbers are absolutely dazzling, gravity-defying, call it what you want. So, let me quickly run through the stats from the week. Now, this week is a week where the rally continued, where levels have come and gone, where the Nifty is taking aim at 11,500. And it's a rally primarily fueled by FII money. Domestic institutions continue to remain on the sidelines. It's really those foreign dollars that have been pouring in that have been propelling this movement. Another interesting facet is that large caps played catch up this week. So if you're looking at the indices as well, the Nifty is up about 3.6%. The mid cap index is actually up 2.7%. So a week where large caps were playing catch up. And all of this despite high crude prices. It wasn't a week where we saw a dip in crude. In fact, Brent continues to hover around $67 a barrel. But that really hasn't stopped the bulls at all. Banks have done very, very well. Towards the end of the week, we saw IT stocks come in and participate. That profit-taking that we saw earlier in the week, that kind of moved out as well. In fact, with that, let me quickly come to the movers and shakers of the week. Financials have been extremely strong, and the rally is moving from the top-tier private banks to the second-rung banks now. So Kotak Mahindra Bank, IndusInd Bank, stock of the week, 13% up on IndusInd Bank. And then you're looking at names like ICICI Bank, SBI, HDFC Bank, absolutely on fire, this entire universe. And then the point that I'm making on oil, despite elevated oil prices, oil marketing companies have been the best performing stocks in March so far. This week itself, look at the gains, 7%, 10%. The market betting on inventory gains, not really worried about prices at the pump. So these stocks did well. Even Bharti Airtel found some takers, and Titan continued to shine bright. Where was the profit taking? Two stocks stood out for me. ITC and HUL. The market's interest is clearly away from expensive consumer stocks at the moment. It's looking for other ideas. So these were two stocks that were on the back foot. Tata Motors, again, some bad news of the other coming in. This time it's vehicle recalls from JLR. Tech Mahindra saw some profit taking for the week gone by as well. That's the large cap action. Again, mid cap slightly more somber than the large caps this week, but there are lots of high flyers. These are just some examples. Some of this is very news-driven, stocks like CG Power, where there's anticipation of a deal about perhaps private equity giants stepping in. Then, of course, names like Dilip Buildcon, road contracting stocks anyway have done well this week. Dilip is an example. Edelweiss, Arvind, NBCC. And last but not the least, do watch out for some of the real estate names, because the real estate index has done well. And that's symbolized in the way, not Indiabulls Housing Finance, Indiabulls Real Estate is a stock that we should pull up. That and DLF. Again, two strong moves from the realty pack as well. So all in all, a well-rounded week. But Prashant, I guess people will wonder whether this is too much, too quick in a short burst of time, whether it's sustainable or not. Yeah. Because it's like that party where you just start feeling a little heady, right?
And the Kool-Aid is being provided by central banks.
Yes.
In that sense. So. On this show last week, we discussed how ECB, I said the last Friday, that ECB is the latest central bank to join the dovish party. And I'm beginning with my small opinion piece here by saying that the Bank of Japan is the latest to join the dovish party in that sense. Not dovish party. The Bank of Japan essentially took a pretty dim view of the local economy. But what that means is that they're not really going to try and normalize anything anytime soon, right? So it is dovish in that sense. It's not good news, but in a way it is good news for risk assets, for things like equities, etc. We also had the Chinese Prime Minister reassuring the market on many fronts. Taxation, the fisc, and a couple of other things as well. And he also had a direct message for the stock markets, which was reassuring. He said that the authorities are going to do everything possible to support the stock markets in China. By the way, retail has been pouring into the Chinese equity market now for the last couple of weeks, and that has continued. US-China trade talks look encouraging. Can we suddenly, one fine day in the morning, get a announcement that, well, both sides are dropping all tariff announcements? What could that do to global markets? We don't know. But, the commentary and the opinion coming in from both pieces, and it's just a trickle, has so far been positive in that sense. US Fed, of course, is dovish, and the latest data, which was, I mean, when I say the last big data, it was the data from late last week, which or the employment number, and that was pretty poor. So Fed is expected to remain on course to be extremely dovish. What does a dovish Fed mean? It essentially means that the dollar perhaps will not have too much support. The dollar should be weaker, and it also kind of puts a cap on bond yields rising, which is again sort of good news for risk assets around the world. Remember, the ECB had joined the dovish sort of grouping last week. So who's left really? I mean, you've got ECB, you've got Bank of Japan, you've got China, you've got, of course, the Fed. So it's almost deja vu from 2 years back when we had a similar kind of situation. Only in 2018, for a bit, you had the sense that, well, now this year is going to be about normalization. Well, we never got normalization, and as we begin 2019, it is basically back to more dovishness because, well, apparently there is no expected growth is to be much weaker than what everybody thought. So in that sense, I mean, all this is pretty good. FIIs have poured in $3 billion in India in calendar 2019 so far. I mean, this is big money, and they're turning their gaze to on India after essentially being sellers. If you take a look at the net FI figures for the last couple of years, and that is some strong momentum. And this is coming in exactly at a time when the local flow has started to come off quite a bit. We saw the February numbers, and it showed that the local flows are now slowing down meaningfully. But FIIs are there, and they're starting to show India some love. So those are the big cues as we go ahead into next week. But essentially, it's positive for risk assets. It's positive for equities. That's the mood all around the world.
Absolutely. On that note, let's bring in the experts to weigh in on the market action for the week. Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, now joins in. Mihir, good to have you on the show. So I'm just wondering, okay, I don't think we have that line through to Mihir just yet. But the real question is, I guess, whether you can still buy in. And that's a question that's really sort of bothering people at the moment. That's what traders have been looking at as well at these elevated levels when you're again approaching 11,500. You're 200 points away from the all-time high on this market, whether you can actually, get in at these levels or not. We do have Mihir with us right now, Chief Investment Officer at Max Life. Mihir, thanks for joining us on the show. So first things first, I mean, it has been a great rally. The feel-good factor is back. But I'm just wondering, for fund managers like yourself, do you have the confidence to now enter in at current levels, or do you think this rally is sort of moved too quickly?
Hi, good afternoon. Yeah, what a week it has been. In fact, what a couple of weeks it has been. So you're right. It's been a tough one, especially coming after the terrorist attacks and the surgical strike. Confidence was really low, and nobody expected this kind of a sharp uptick in the markets in such a short period of time. It, of course, as you did mention in the earlier part of the show, has been driven dominantly by FIIs. And that's because of the dovish stance that has, kind of emerged in the last few weeks from the Fed, the ECB, as well as some of the other central banks, including our own central banks. So, this kind of a rally is obviously a good rally in the sense that it takes away the immediate, negativity which was there around the terrorist attacks and the military action. But the fact is that on the ground, still things are still slow. We do see signs of economic slowdown. And to that extent, while it becomes tougher to take a call on the market, we could and we are taking specific stock-specific calls, so to say.
Fair enough. Mihir, so I get the sense that you'd want to be cautious while the party is on, money is coming in, but you'd want to be careful with deploying more at these levels, given the fact that, well, elections is also around the corner.
Yes and no, in the sense, the probability of regime change in the elections has considerably decreased if one were to go by the opinion polls. That also is feeding into the positivity in the market. That's as that's one uncertainty that's kind of receding into the background. And second is that, as I have mentioned earlier also, we were anyway not going to go into the elections with a big call either ways on the outcome of the elections, given the historical experiences of 2004, where the markets, were down 20% in a couple of days, and in 2009, where the markets were up 18% in a day. So we would have probably, preferred, and we do prefer to go in a little neutral into the election without taking a big call either ways. So the basic call continues to be that on the economy, whether we see growth picking up, and of course stock-specific calls, as I mentioned. The good thing is that because, as we know, that the markets were driven by a very few stocks in the last 12 months, there was huge valuation differentials. So picking cheaper stocks to that extent was easier, and that's what probably the market has been doing. If you notice the top movers in the last 20 days or so, there are a lot of these bombed out value stocks which have done very well.
Okay. Mihir, there's increasing interest obviously coming back in financials this week. That's the part of the market that saw a lot of money come through, private sector banks, even names like SBI, even select NBFCs. Now here, would you still be willing to back a move on, let's say, corporate banks, whether it's SBI or ICICI Bank, a lot of these lenders which have already seen a big rally?
So, the financials is almost 40% of the Nifty in terms of weightage. And what we are seeing is a lot of FII flows which are benchmark oriented, if not completely ETF driven, so to say. So 40% of flows anyway naturally come to the financials, and that's what's happening. That's why we are seeing a good rally in the banks specifically, because a lot of the money by default comes to this segment. But having said that, we have, as I mentioned, been shifting a bit towards the corporate banks in the last 5 to 6 months because of the relative valuations, and of course, top management changes in a couple of the large names, which kind of increased investor confidence. But NBFCs, we are again being very selective. We don't have much exposure, and the conundrum there remains the same, that the high quality ones, the good ones, are getting all the money, but and they are able to grow their balance sheets. But in our view, they are still quite expensive. And the ones which are not perceived to be that quality are still not getting money, and they can't grow. So NBFC weightage to that extent is less. But yes, versus pure retail banks, our exposure to corporate banks has increased.
What's going on with real estate and the interest there? Is it the the REIT which opens next week? I mean, we've seen names like DLF come up sharply. I mean, absolutely no interest at 140, 200 plus now.
I think it's part of the same theme of the really beaten down segments of the market coming up. And there is also a talk of fundraising in some of the big names in the real estate space, not only through the REIT route, but also through QIPs. So to that extent, there is some action happening. We hope that the segment does well, because in my view, I don't think the economy can deliver high growth without the real estate segment, especially the residential segment picking up. And while the government has done a lot to encourage this sector to pick up, I think a lot more needs to be done, because there is really not much traction at this point in time. But there was some value, and I guess that's what's driving the stocks up in the last few days.
I see. Okay. Mihir, right now, if you were to deploy incremental money at levels which are already elevated, what would the preferred route be? Where would you be looking to park it?
So maybe a couple of weeks back or a month back, the answer would have been more towards the mid-cap space, but I think that's also run up quite sharply. And as I said, on the ground, there is not much movement happening. Funding is still an issue for NBFCs and for the smaller corporates. So I would stick to the larger names even now.
Stick with the larger names now. Would you say broadly that when you said that last 20 days were about some of the bombed out value stocks getting bid up, that process is over in a very top-down, broad way?
No, there is still some valuation gap. If you look at the top movers of the Nifty for the last, say, 12 months, Even now as we speak, there are stocks which are up 75% and there are stocks which are down 40-50% even after moving up significantly. So if you just look at pure value and valuation differentials, there is some juice left probably as far as the convergence of valuations is concerned. However, of course, just to caveat, that's not our style. We prefer earnings growth at a reasonable price. But as of now, that's what the market's doing.
Okay. Just a word on one sector where there's still a big debate, Mihir, the auto space. Now, stocks have bounced from the bottom. There are big movers here as well. But would you be convinced? Do you think we've seen the worst, whether it comes to some of the ancillary stocks like a Motherson Sumi, or whether it comes to OEMs like maybe Maruti or Eicher?
No, automobiles, we still don't see traction. I think the inventory in the system that was built up in the last few months is still around. Discounts are still prevalent. So while valuations have become relatively cheap, it's difficult to take a call just on cheapness because we prefer stocks which show some earnings growth. Of course, we like the segment in the long term. So I think if you were to take a 3-year call, probably it's time to start nibbling at least, if not go the whole hog. But in the shorter term, things still are sluggish.
Okay. Amir, thank you very much for joining us. Appreciate you joining in with that perspective on the market. Thank you indeed. Amir Vora there with some opinion. We will move on and let's prepare you for what is coming up our way in the week ahead. All of the global and domestic market activity in a snapshot. Anisha is standing by with exactly that. Anisha, over to you.
Yes, it might be a truncated week for us on account of Holi, but then there are a whole host of local and global events lined up for the week. For example, at least 5 or 6 central banks are going to meet in the coming week, and the most important of them all is the US Fed. So remember, the FOMC meeting will start on Tuesday. We will hear the announcement on March 20th, and the expectation is that there will be no rate action. However, the key thing that the street is watching out for is the timetable of balance sheet reduction and any comments on it, because remember, the Fed Chair Jerome Powell had suggested that in the month of January itself. Other than that, it is expected that the FOMC might take on a bit of dovish tone. Other than that, the event that we are watching out for March 20th is the release of the US crude inventory. So keep an eye out on that. And in the European region, the key thing to watch out for remains the Brexit developments. Now remember, the British Prime Minister Theresa May is trying for the 3rd time to persuade her MPs and trying to get them to sign her deal. Remember, the Commons will vote on her withdrawal agreement by March 20th. So keep an eye out on that. As far as the local cues are concerned, the key event to watch is the GST Council meeting on March 19th. It is expected that they will discuss the transition norms of the real estate sector from the old rate to new sector. So keep an eye out on that. Other than that, a couple of deals which are in pipeline are expected to fructify this week itself. Keep an eye out on the debt resolution process, as well as the L&T Mindtree deal. And lastly, it is the first time that a real estate investment trust is really coming out to the market for IPO. So Embassy Properties is really looking to raise around 4,700 crores from the markets, and it will be the first IPO of its kind when it comes to the REIT. So watch out for that particular event on Monday as well. Back to you.
Okay, all right, Anisha, thanks so much for summing that up for us. And yes, indeed, real estate is making headlines because of the fact that REITs are finally making their presence felt. Embassy Office Park REIT is going to hit the market next week. Sonal Bhutra joins in with details on this one.
Well, that's absolutely right. India's first REIT IPO is all set to open on the 18th of March, and it is backed by Blackstone and also in collaboration with Embassy Group. So what actually is a REIT? It is a company that owns and operates income-generating real estate, and it can be a commercial property like hotels, buildings, and also hospitals. In simple terms, it is a mutual fund, but the underlying asset is real estate. So if you are an investor with minimum 2 lakh rupees to invest, REIT is a place to go to. where do these REITs actually invest their money? 80% of the value should be invested in completed and revenue generating projects, and the remaining 20% could be investment in something like a developmental properties, mortgage-backed securities, and also corporate debt of the real estate sector. Let's talk about the IPO that's opening on the 18th of March. Well, basically, they will be raising around 4,750 crore rupees, will be offering around 158.6 million units priced between 299 to 300 rupees. This is 20% discount to their actual NAV. They will be offering around 8.25% of yield that will be distributed in form of interest and dividend, and it will be equal in amounts. Proceeds will be used for debt repayments and also for acquisition of one of their assets, that is One Embassy. Overall, they have a portfolio of around 32.6 million square feet of office space, 2 under construction hotels and also 2 completed hotels. So the overall value that is ascribed to this portfolio is around 34,000 crore rupees. In terms of future prospects, MOSL says that they expect revenue growth of around 46% in next 2 years, and also the company expects their lease rentals to increase by around 17,600 crore rupees over the next 2 years. So the prospects for the company look really good, but since it's a new avenue for investment, we'll have to really see how much attraction and how much interest do they really gain from the retail investors. Back to you.
Thanks very much, both you guys, for running us through the events to watch and the REIT which is going to be in focus on Monday, starting Monday.
I think we are at the beginning of a new fundamental cycle. Now, these are long duration cycles. They tend to last for 5-7 years. So arguably, I would say that, we are at the beginning or, maybe a few months into a 5-7 year cycle in which I think we should witness pretty strong earnings growth. It will not surprise me if earnings, put in a 20% CAGR over the next 5 years.
Rallies and dips are all part and parcel of this journey. I think what has happened, the most important of all, is that I think a fortnight back, there were 2 concerns. One is what happens post-May, in the sense, do we get a stable, strong government, or is it going to be one more kind of a coalition? So there was some kind of concerns on the political front. And then, of course, the other concern was on the geopolitical front, that will this escalate further? Thankfully, it has not. So I clearly think that both these apprehensions have been put to rest. And then, of course, third, aspect is that globally there's been a rally. I think April, May will be very critical. Of course, yes, the election outcome is going to be important, but I think along with that, is there now a renewed confidence in corporate India that earnings can get into the double-digit zone or not? And I think that's going to be very, very important.
The Indian economic growth cycle is stronger than any political party from a long-term standpoint. But one of our hopes and expectations would be that if the current ruling party and in a coalition or on its own comes back, the government comes prepared with a stronger, clearer idea of what they want to do early after election. If you get a new coalition of a lot of different parties, we don't know how long it'll take them to formulate a cohesive strategy that can help propel some, business confidence, some recovery in overall, animal spirit, so to say, in the economy. And therefore, I think that would create, obviously, a headwind and an opportunity to buy at lower level.
Okay, so that was a slice of the opinion that we picked up during the course of the week. You are watching Taking Stock. It is time now to talk technicals. We have Mitesh Thakkar joining in to tell us about the trade setup as we're entering next week. Mitesh, this was a red-hot rally, and we've seen a gain of 3.5% on the index. How do you sum things up, and where does it leave us when we come back to trade on Monday?
My sense is that I think the Nifty has met an important target, 11,500. If you look at the historical chart, sometime in September 2018, as you were correcting from the higher side, we had rallied about 11,515, made a swing top, and then corrected from there. So we are quite overbought. We've rallied and we've hit an important supply point in terms of 11,500, 515 zones, or very close to it actually. My sense is that these are good levels to take profits on trading long positions if you have them. Wait for a decline. I think on the downside, 11,220, 200 zones will not be violated. So anything close to about 11,300, 350 would be an ideal zone if you get a dip. Else, you might get a consolidation, and on a breakout of that consolidation, you might want to enter again.
Okay, Mitesh, your top trades then for the coming week?
Yeah, I would choose a buy on Tata Elxsi. I think that's one of the IT names which kind of participated towards the later part of the day. Keep a stop at 960, look for targets of 1,010. And the other stock which I like is Torrent Pharma. which has had a strong closing to the week. That's a buy with a stop below 1840, and I would look for targets close to about 1900 there.
Okay, Amitesh, thank you very much for joining us and running us through what you would trade and your view as far as the week is concerned. Amitesh is essentially saying that wait for dips now, and you get those dips and then you get in. But the trade, of course, remains to be long. With that, it's a wrap here on this edition of Taking Stock. Surabhi?
Well, we'll take your leave and we will see you again with market action bright and early on Monday morning. Have a great weekend.